Welcome to yet another video of VivTalks series. VivTalks series is becoming so special series for me. I'm inviting people who inspire me a lot, and at the same time, I try to get as much conceptual understanding from them regarding the domain where they are expert. In this video, I have Radhika Gupta with me. She is the MD and CEO of Edelweiss Mutual Fund. She is amazing, and I'm sure you will find a lot of learning from her in this video. We are going to discuss about life, we are going to discuss about career, and also about mutual fund as an asset class in totality. Watch till the end, you're going to love it. Hello Radhika, how are you doing?
Good. Thank you, Vivek, for having me.
So good to connect with you. I'm really thrilled. As I said in my introduction, that there are some people who really inspire me, and Viv Talk is all about deriving inspirations from them. So, Radhika, you have been a great inspiration for the entire industry, I would say. Beyond industry, obviously, a lot of people would get back to you with their own version. But since I'm an industry person, I would say that the entire financial services is so proud of you, and we get inspired from you.
Thank you.
So, Radhika, today I want to obviously talk about you, but at the same time, there is so much to talk about the industry, the fund management, the investment, and especially in this scenario when market is not at all conducive for active participation. So, probably this is a great market for passive investors to look at the market now. So, how and when can we do that? And also, I'm going to touch a bit on the women's side because I believe that there is such an immense potential of women in our country to come mainstream into the financial market, either as an active market participant or as a passive market participant. So I'm going to touch that also, if you allow me to do that.
Absolutely.
Great. Yeah. So before I get into more technical discussions with you, could you spend some time and tell us about your story, a brief story that what made you come to this market? If I remember, you told me that you came into this financial services industry as a MD and CEO of Edelweiss Mutual Fund the last 5 years, right?
Yeah. So I think, the funny thing about financial markets is, Vivek, I joined this industry without thinking I would join the markets industry. So I've been running Edelweiss Mutual Fund for 5 years. And I've been in the asset management business for 15 years, which has largely been my whole career, 15, 16 years. And I graduated from a finance school. So I come from a family, as some people know, that has never had anything to do with finance or corporate India, actually. In our world, the thinking was there's public sector and private sector, and everybody came from the public sector. So that was the language that we grew up with at home. And I joined the finance industry a little bit out of a lark because I graduated from a business school, which is Wharton, which is a very finance centric school. And then I've been in the finance industry for 15 years. And one of the things, a former boss of mine, I used to at the hedge fund. So I graduated from Wharton, I worked at McKinsey, and then I worked on Wall Street from 2005 to 9. And then I came back to India, set up my own firm, sold it to Edelweiss, and I've been essentially running the mutual fund business for the last 5 years. I think one of the great things about the finance industry, and a former boss of mine, the founder of AQR, told me this. And, I used to ask him, why are you in this industry after so many years? I mean, he was a billionaire. He had multiple yachts. I think his yachts, by the way, were called Duration and Accrual. So he used to have these two yachts that he used to race. And it's like, what keeps you going? And he's like, this is one of the only industries in the world where you learn something every day. And I think as someone who's traded, you can appreciate this because he says either you make money every day, and that doesn't happen. I mean, you and I know that, and anyone who's been in this industry knows that. Or if you don't make money every day, there's something to learn. And I think that's my story of what financial services teaches you, because there are so many cycles. You learn something with every cycle. Every cycle is sort of similar to the last cycle. Cycles don't repeat, but they rhyme. So there's similarity, yet there are differences. You're constantly learning. You're on your toes, and especially I think in India, Vivek, where capital markets themselves are evolving so much. It's a great place to be.
Yeah, true. So, Radhika, I want to represent myself as a normal investor of India. And I'm going to ask you a few questions which are more from their perspective, because so much is required to be answered. When we
Yeah.
talk about financial services industry, we have always seen cream clean, great people join that industry as someone who is providing services to retail, right? And that's, and when I was doing my MBA, that's what always the most sought after occupation, कि यार मुझे investment banking में job दिला दो मुझे, and that is what I want to do.
Correct.
Even a civil engineer who has done engineering and then MBA wants to become an investment banker. So why
Correct.
is it so much fascination for people to join this industry and not do maybe
Hmm.
more of a real work, or a not real work, pardon my my uses of the word, but why
Hmm.
are not people getting into doing infrastructure work rather than becoming a financial services market participant?
It's funny, Vivek. I've talked about a very similar analogy, the everyone wants to be an investment banker analogy in my upcoming book, because I think it's so true for all of us who graduated from campuses. Yeah, I think the problem is, and I think the finance industry is a great industry. It is a very, very professional industry. It's a very fast-paced industry. It's, of course, a very well-paying industry, and that's why it attracts a lot of smart people. Uh, you know, I do think a lot of people want to join this industry, and this is not a politically correct thing to say because of the apparent glamour and money. There's a belief that when you're talking about financial markets, it's super glamorous, and if you're talking, you're going to make a lot of money, and you have movies like The Wolf of Wall Street that portray a certain lifestyle that comes with financial services and a certain aggression. I think that's a little bit of nonsense. 15 years into the industry, and it's a little bit like the halo around the startup industry today. I want to be a startup so that I can become a unicorn and I will get these XYZ valuations, and then I'll be on the cover of Forbes and whatever, whatever, whatever. I think there is a lot behind the glam, or the film industry, right? I mean, or the
Hmm.
cricket industry. I think there is a lot more than the glamour that these industries have, and if you join them, including financial services, for the glamour, it's not going to last. And I've seen it with so many friends and colleagues, because what you also forget with financial services is that alongside the glamour comes serious cycles, and those cycles are hard. I mean, you see people losing jobs. You see your lifestyle change. Like, you remember 1.5 year when markets were nearly up every day, mid cap funds were delivering 50% returns, and we come to a period where the last 1 year returns are maybe a meager 10%. So financial services also has very extreme cycles. And
Hmm.
it's not the cycles that you see in numbers on paper and that the media puts out, it's cycles that affect individuals. So I've seen everything in this industry. I've seen mass layoffs. I have seen 22-year-olds getting bonuses that they could never imagine. So it's an industry of extremes, and I'd encourage anyone young not to fall into the trap of loving the glamour.
True. um, as a someone who has a fiduciary responsibility of managing people's money, and people are giving their hard earned family wealth to someone like you to manage them prudently. uh, I know we, at times when we see that we don't get return from it. Say for example, there is X mutual fund who has not generated great returns in the last 5 years, and 5 years
Yeah.
ago they were very glamorous. People were like, wow, I have to give money to them. And today people are, I mean, they have vocal critic about them. So obviously a fund
Yeah.
manager would feel certain way that yaar jab return bana raha tha to everything is fine, and now I'm not generating
Hmm.
returns, so suddenly you are coming after me. So that pressure of constant pressure of performing for the client, how do you guys manage that as a fund manager?
It's a great question. So first, I would say that managing other people's money is much harder than managing your own. You're far more careful about it, and I don't think people appreciate that, because there is a sense of responsibility, especially now that I've managed high net worth money in our past life, and we still do have that business. But when you're managing retail money, you know that this money is someone's retirement savings. You know that this money would pay for someone's college education, someone's hospital expenses. And whether it's 500 rupees or 5,000 rupees or 5 lakhs rupees, it's hard earned money and it's ordinary people's money. So I think not just us or me or Edelweiss Mutual Fund. I think anybody who's a money manager carries that risk. If you're a good money manager, you live with that responsibility. You also, I think, though, Vivek, you talked about performance. I think one of the things you have to realize is one, the input performance is an output. The
Mm,
process and the effort you put in is the input. I think that should never be compromised. So my approach, and I've worked with so many different fund managers and very talented fund managers, is that we focus on the process. We have a well defined, if we're running a mid cap fund, for instance, we're
mhm,
very clear about what we're doing, why we're doing it, what we will not do. So no compromises in a mid cap fund of taking cash calls or running large cap fund. We're very clear about ye karenge. This is what we will not do. This is how we will invest. This is the mantra or the philosophy that we use to choose companies with. And we also realize that there will be times when that doesn't work. I think, to believe, and I would love for ordinary investors to know this, that no matter how hard we try, there will be times when that particular approach and philosophy will not work. And that is something that we have come to realize. But the test is really, and the test for me as a CEO is in making sure that we stick to that process even if it doesn't work. And it's true of life as much as investing. So if you stick to it and if the process is decent, then over time you will do well. So I think one of the things we as fund managers try to do, or money managers, is there's a lot of drama in the outside world, as you know, especially in markets like this. We try to keep ourselves away from the drama. The short-term drama, X billion dollars of market capitalization wiped out, etc. Of course, you keep an eye on your stocks and risks, etc. But you also have one, sharp eye on the long term,
mm.
and in the long term, you do make money. So I think, the idea is focus on your process, stick to your convictions, and this I think is where experience helps.
Well, Radhika, but finally, when we as a retail, again, I'm representing that audience, when we look at process, we don't look at the process. We only look at the return, that itna return bana hai, nahi bana. Is fund ne, the classic screener everywhere is that which fund has given good return in last 1 year, 2 year, 3 year. So we don't know the process. So let me give you an opportunity. And this is, so friends, let me tell you that this is all impromptu discussion. There is no preparation, and I'm neither
Yes.
promoting any product or anything, but let me just give you this opportunity. Let us know the process which Edelweiss follows, so that people who are invested in Edelweiss know exactly what is behind, what is happening behind, because 99% लोगों को तो पता ही नहीं है कि पीछे चलता क्या है.
Or yeah, I think, I mean, it's an impromptu question, but it's a fab question, because one of the things, and I'm actually going to walk you through the process for one of our more popular funds, which
Hmm.
people know. But one of the things, Vivek, when you go to a lot of screens, as you said, you see best performing fund in 1 year, 3 year, etc., etc. And the human tendency is, what you do is you sort by 1 year and 3 year, etc.,
Hmm.
etc., and
Hmm.
you just pick the best performing one. And the one thing I'd like to tell anyone who's listening is that's the worst way to go around picking investments. I mean, yes, long-term performance matters. In 10 years, the fund should beat the benchmark. It should be, doing well in its peer group. But this is not a race of horses. This is
Hmm.
not, okay, let me pick the best one today, because the best one today, and I mean, Mint just put out a really good report last week. The best one today could be the worst one next year. This is not
Hmm.
a horse race. So, and many mutual funds, not just us, we definitely do this. In fact, on our website, and this is not meant to be a plug, we have a document for each of our funds. It's called Behind the Scenes, little
Oh.
bit inspired from the language of cinema. And it says this is the process of our funds. It's a 4-page document. It's not so detailed that you'll get bored reading it. No one's going to read a 20-page document, but it at least gives you an idea. So let me pick, we have a fund called Edelweiss Balanced Advantage Fund. It's a large fund. It's one of our more popular funds. And essentially the fund's job is to deliver you moderate returns without too much of a heart attack. This is in very simple English. It holds a mix of equity and debt. And it's typically 30 to 80% equity, and the balance is in fixed income. And the idea is, अच्छे market में you will participate meaningfully, and बुरे market में you will not fall as much as the market. Now, we've actually got this process document, and the process behind this fund is very simple. There are three things, there are three decisions the fund has to make. I mean, you can relate this to life. One is how much equity to invest in and how much debt to invest in. And I'll talk about how we do that. The second decision we make is that in that equity, what kind of stocks to buy. And the third decision we make is in that debt, what kind of bonds to buy.
Sure.
The most important of these three decisions is how to choose between equity and debt. Now, we have a framework for that. And I'll just give you a simple example that relates to driving a car. In Mumbai, if you were to drive on a highway and the weather was really clear and the highway was nice, you might want to pick up speed in your car. You might want to go faster. But if the weather was very poor, and you wanted to, it was rainy and the roads were bad, you would slow down. It's because the road health is not good. So we have something called the Edelweiss Equity Health Indicator, which looks at market health. When
Okay.
market health is good, we have a lot of equity exposure, like last year. When market health is poor, so our equity exposure could be 70-80%. When market health is poor, like it currently is, which means when markets are choppy, they're volatile, they're big movements every day, and we have 3-4 parameters that are available on our website which we quantify, then our equity exposure is low, like it is
Sure.
right now. So right now it's 35%. It's drastically fallen in the last month. So this is our process, and this process will work when markets move very sharply. So if markets are moving sharply up, we'll do well. If markets are moving sharply down, we'll do well relative to other things. If markets go nowhere, then the car will be confused whether the weather is good or bad. So this is just, I'm giving you one example of investment process that can be consumed by a retail consumer, and this data and information is out there. And I just encourage everyone to go out and read it.
Sure. Sure. That's very interesting. Great. So, when you say balance fund, I mean, this is one example which you gave where a fund manager is trying to dynamically change based on the view of the market, right? As a retail investor, there are two category of people. One who says that I will take that call when I have to invest in
Yeah.
debt and when I have to invest in equity, and the other one is like that I
Mm.
don't have time, I'll leave it to the fund manager. But still,
Yeah.
the other category, the passive one, would like to take more exposure in equity, maybe because of his or her own likings. So let me, let's do something very interesting. Let us divide this discussion for different age groups. Say a
Mm.
20-year-old, 30-year-old, 40, 50, and 60-year-old. Okay. And let us build a good mutual fund portfolio for them. Okay, this will be very
Lovely.
interesting. So a 20
Yeah.
year old who has small capital to invest, maybe a capital worthy for SIP, because every month they are getting some money from their family or whatever sources, and they have some capital to invest. So how do the allocation works there for in specifically in mutual fund?
So I think if you're a young investor, if you're in 20s, and obviously even at that age group, look, people, I mean, the age mantra works, but it doesn't work fully. I think you should start doing SIPs. You have risk appetite and you have time. So I think for a 20, but the only other problem as a 20-year-old Vivek is you know less because you've invested less.
Yeah,
So I
yeah.
think one, you should do simple things. And maybe you will have a combination of a flexi cap fund as your core exposure and something like some mid and small cap funds, because you do want to create wealth over a long term. So I think these two are your core SIPs. So, if you have 100 rupees, and of course, this is very variable, so don't take this as advice. You may have 40-50 rupees in a flexi cap fund, another 30 rupees between a mid and small cap fund. And you might want to have a little bit of exposure to global funds like US market or Chinese market, again through SIPs. So essentially what you're doing is you're a salaried person and you probably have 4-5 SIPs running in these categories of funds. And this accounts for 80% of what you do. If you're conservative, you might add a little debt here and there. But essentially, when you're that young, capital is less, time is more, risk appetite is hopefully there.
Right. This is interesting. You just bought this global offshore fund, and there is huge interest among people these days, thanks to all the fintechs who are asking people to invest directly in equity in US market or whatever market. But I saw Edelweiss has a very interesting product called Chinese offshore fund, if I remember correctly.
Yeah,
Please tell us what is
yeah.
it? Are you investing directly in Chinese companies? How does it work?
Yeah, and this has been again one of our more popular funds. So we actually have one of the oldest baskets of international funds, six funds, of which Edelweiss Greater China Fund is the one that you mentioned. We don't invest directly in these markets. We work with a large global asset manager, JP Morgan. They're one of the largest financial services companies in the world, actually. And they actually have a team sitting in China. So there's a JP Morgan China Fund, and we give money to JP Morgan. The reason, Vivek, we choose not to do this ourselves with the case of international funds is we believe that each market is very different. A market like China is very complex. And if you look at our team at JP Morgan, they have 15 people sitting in Shanghai slash Beijing, people who are speaking Mandarin, people who are familiar with local dynamics, and they're really doing active stock picking. So this is not a diversified portfolio. It's 50, 70 companies picked from a big Chinese market, same themes as you would see in India. So, I mean, in that sense, China is a very parallel market to India.
Hmm.
So you'll have where you have an HDFC Bank here, they'll have their Ping Yang, etc., etc. You'll have biologics companies or you'll have technology companies there. We've heard of some of them. So, that's how we do it. For global companies, we decide we don't make the fund management decisions. We work with great people who have solid fund management teams. And the reason for it's interesting, Vivek. I have been selling international funds since 2017, well before it became very popular, because we acquired at Edelweiss a company called JP Morgan Mutual Fund. And
Oh,
this is in 2016. And so we got three, four international funds, and by chance, my team would go around and sell them. At that point, people would tell us, why are you talking about China? India to itna acha karta hai, and things like that. Why are you talking about US? And the whole tech boom hadn't happened in the US. Now, and in the last 2, 3 years, the maximum questions we answer on these funds. So I think it's fantastic. And if you come back to the asset allocation you said, of that
yeah.
20-year-old, 30-year-old, I do think 10 to 30% of people's capital should be in overseas funds, because different markets perform well at different times. You have to have some exposure to the US, and you have to have exposure to other emerging markets besides India. And the biggest one is China.
Sure, sure. So, okay, let's come back to now 30-year-old. 20-year-old, we are sorted. So, 30-year-old, do you think there will be any different capital allocation than for 20 years?
So I think, it is very individual specific, but I think
Hmm.
as you move from your 20s to 40s, what does happen is liabilities increase. You
Yeah,
may want to, when you're in your 20s, often you don't have many goals. You're just investing, which is fine, it's lovely. As you become 30, as you get older, perhaps you have a household to support, you have the realities of a home loan, you may have children that are coming on the way. So you have goals. So what needs to happen then is asset allocation needs to be a lot more thoughtful. So essentially what you need to do in your both 30s and 40s, I'm saying, is you need to divide your money into three buckets. Money that you need in the very short term, because you will have realities of spending in the short term, and that goes in very safe debt type of instruments. Then there is money that you need in the 3-year kind of bracket, and that should go in your balanced funds and things that I talk about. And then the balance money is your really long term money,
okay.
and that goes into equity funds, flexi cap, mid cap, etc., international, etc. But the orientation, I think, changes from your 20s and your 30s and 40s to become a little more conservative, and more than conservative, goal oriented.
Sure, sure. I want to talk to you about bond funds.
Yeah.
Now, we all know that theoretically bond funds have two risks, the credit risk and the interest rate risk. And in this
Mm.
kind of a scenario where barring this Russia issue, I mean, the world is already talking about yields going up and interest rates going up. So bond funds obviously becomes not so attractive destination. So under that
Mm.
scenario, what should an investor do? Because equity market has already gone up. Bond market, people are scared that because interest rate will go up, may not generate return. So where is the right
Yeah.
opportunity to park that new money which people are making?
Okay, so I have a take on bond funds, which is one, I think consumers and investors, and maybe it's our fault as an industry, don't understand bond funds and bond risks as well as they should.
Yeah.
Uh, you mentioned credit and duration. If a small cap fund falls 20%, there's no noise. If a liquid fund gives a 0.5% negative return, I can't tell you the amount of noise that there is
Yeah.
around us. हम लोगों का background देखो, we came from savings account and FD. There
Uh,
was nothing negative in life. There was no mark to market actually. So you know that I always say the fixed income becomes a very big sticking point. Now bond investing is not complicated. Why do you invest in bonds? You invest in bonds for safety.
hmm,
There would be two things I would do in this market. And remember, if you are a full people often forget this. If you are a full tax investor in India, you have two choices as far as fixed income. One is you put your money in an FD. The second is you pick a debt mutual fund. I'm not saying this because I'm a mutual fund manager. The tax on a debt mutual fund after indexation comes out to be 10-15%. You pay full tax if you're a marginal investor on an FD. So there is a serious cost to not thinking about bond funds. One,
hmm, hmm,
there are two things I suggest you do. Have a barbell approach. There's very short money that you need,
hmm,
money that you want to spend in 6 months, 1 year, etc. Great funds for these are liquid funds and a category, Vivek, that you of course will be very familiar with, which is called arbitrage funds.
hmm,
Arbitrage funds are a kind of equity fund, but they give debt returns and they have equity taxation.
hmm.
So from a tax point of view, they become very efficient. So liquid funds, arbitrage funds, very simple, nothing else. Um, then, if you want to park debt money for the long term, and long term I mean more than 3 years, there is a great instrument called a target maturity debt fund. It's like Bharat Bond, many people are familiar with. These are basically funds that buy bonds and hold them to maturity,
Hmm.
and they have different maturity years 2025, 27, 30, 31, etc. They, because you talked about credit risk, they typically hold state government and PSU bonds, so that is not an issue. And you know the entry point yield. So again, if you go to edelweissmf.com and go to passive debt funds, you will just see 2025, 6, 7. Like in FD rate, you see the indicative thing. And if you sit and hold to maturity, regardless of whether rates go up, Putin does this, oil does this, all of that, for a hold to maturity investor, you will realize that rate of return. So it's called a target maturity debt fund. Do check it out. For long term debt investing, choose the year you need the money in, just like you do for an FD, and pick the target maturity date.
All right. All right. So that means you are saying that if you are a bond investor, you are comparing with FD. So it has to be a long-term investment. It cannot be because the interest rate fluctuation will impact more at a shorter tenure, but for a longer tenure, it's not much a risk
It doesn't
associated.
matter.
All right.
Exactly.
Got a point. Now, we talked about 20, 30, 40. Now I want to talk about post 50. And so many people are, I'm interacting these days, who are retiring early, getting into the market, trading full time because they feel that they can do it on
Mm,
their own, and parking certain capital as a recurring income for their future, which is okay. Some
yeah.
people want to follow that path. It's okay. I want to give
Mm.
them a proper, direction to an investment instrument which will kind of assure them of a regular income so that they can experiment with the other capital if they want to, but still some instrument maybe out from the mutual fund industry that after 50 you have to invest here because that is the best source of recurring income for you.
Okay. So I think if you're after 50, and obviously, again, people have very different circumstances after 50, depends on your income after 50,
Yeah.
definitely more conservatism and a word less mark to market products that can give you more regular income, and I'll go into that, are the direction that you have to go in. Now, I think your portfolio can have a mix of three things. I think the balanced advantage product that I talked about, the hybrid category in general, is a very good core thing for a retiree, and that we've seen a lot of people use.
Okay.
You can supplement that if it's too risky or too aggressive. If you want to add a little more equity, because like my father is a retiree, but he doesn't have any liabilities and he has a regular income. So he can take more risk than a BAF kind of product. So you can add a mid cap fund or something like that, or a equity fund. If you want to make it more conservative, you can add a little bit of the long term debt funds that I
Okay.
mentioned. But I think that becomes a nice core offering because you have wealth creation and a balanced advantage kind of product. You're beating inflation, which is very important when you are thinking about the journey from 50 to 80. And what you can do is, Vivek, you don't ask for regular income immediately. You let a corpus build up for 2-3 years, and then say the balanced advantage fund is returning 10-12% a year. You can do an SWP of 8% a year, maybe 80% of the amount or 70% of the amount, so that you don't touch your capital. You can do a monthly or quarterly SWP. It becomes very efficient in terms of taxation. So that's something, for instance, we do for my mother-in-law, uh, single, retired, etc., etc., as a way to get income back. And you can do a quarterly one and get quarterly income back.
Okay, okay, sure. So let's talk about uh, empowering women in our country. And as I said initially, that's the segment of society which has to come up now. And we have
Mm.
seen traditionally, my mother, my wife, they are great financial manager when it comes to household management. And but when it comes to understanding of external finances, most of them don't understand banking system, or I mean, they are kind of relying on other people. Ki tum kar do na, tum jante ho ye sab. What would be your advice to them, that how do they come out of that cocoon of break free and get into hands on about their financial management as well?
So I say two things, and I'm a little bit of a broken record on this, but I think it's important. One is that, as you said, this is not a job that can be outsourced. There are lots of things we should outsource in life. That's great. This should not be outsourced. And there are many reasons for that, Vivek. One is, you set goals as a family. Husband, wife come together to set goals as a family. And money is finally used to meet goals. Now, if goals belong to both the husband and wife, financial decision making has to belong to both the husband and wife. Secondly, life is unfortunately uncertain. We have seen phases like COVID-19. We've seen phases where, divorces happen, women are left in the lurch. I've seen things in my own family. Every family has one of these
Mm.
stories. You know, Money is not everything in the world, but it enables a lot of things. So knowing where the hard-earned money lies, how it can be accessed, that it's used properly. A lot of working women don't manage their own finances. So I think that is the second reason that this needs to not be outsourced. And the second point I would make, Vivek, is, which is touching on what you said, is that it is not difficult. As you said, there is a myth that to be a great investor, I need to read big books like this and be on Bloomberg screens all day and trade. You can be a passive investor, as you very rightly said. Mothers, grandmothers were bloody good at managing money. They were good at managing the household and limited resources, and the basic skills of having goals, knowing how much risk to take, being disciplined, continuously saving and accumulating, doing an SIP. ये तो सालों से खानदानों में होता आ रहा है. So I don't think it's not complicated. And thanks to guys like you and many others, there are so many resources out there. So one, don't outsource it. And secondly, you can do it. It's not that difficult. So that is what I'd suggest. And the third thing I'd say is men can play a very important role in this.
Mm.
Because men are the ones typically who take the lead in financial matters. Encourage your wife. If she's asking a question about finances, don't say, oh, if she asks more, she'll know more and she'll ask me difficult questions. Encourage her to get to know. And my husband and I have done this for years. Do a quarterly review of all the bank accounts, document this, all the finances, the entire portfolio. Help her get into that fold. It's a partnership, right? So
Mm.
I think men can play in the households a very important role, because there are two approaches a man can have to this. One is like, why do you need to know? Oh, you don't, tumse nahi ho payega types.
Mm.
And the second approach is, look, it's great that you want to know, be my partner with this.
Absolutely. So ताली दोनों हाथ से बजती है, तो I think
Uh,
all of us have to become sensitive to this. Uh, but tell me, Adhika, if someone wants to use this opportunity to make money from financial market, what kind of opportunity a lady, suppose a typical middle class lady in house who is a homemaker, taking such an important responsibility, but still want to make that extra 5,000, 10,000, 20,000 rupees a month by being in the market. These, a lot of them are coming into the market to become traders, and I tell them that please try understand the risk and reward associated, and so much
uh,
time you have to give to make money as a trader from the market. But if someone
mm,
wants to give, say, weekly 10 hour, uh,
mm.
then how do one make extra money from this market? What kind of
Yeah,
business one can do?
I'm not an expert on trading, but I think if you are, a woman at whatever age and you're looking to invest, uh, in India, the equity market will be a long-term source of wealth creation.
Hmm.
Our corporations, our companies, our economy is growing. And while there will be patches like this where markets are down day after day, it feels frustrating. I think in the long term, there is growth. And for women, there is an opportunity to participate in that growth in a very simple and passive manner. And I think, I keep telling every lady, if you can't do anything, just take an SIP and start an SIP in a basic, simple index fund or flexi cap fund or one of these funds. Start it with a small quantum, understand gradually, understand the asset class, and let it grow over time.
So I think first thing first is get control of your bank account. Know the money
Yeah,
which you have in your bank account, and then open an account with a mutual fund. Start SIP. That itself will give that unknown thing will move out, and suddenly we'll
right.
realize that अरे ये हो सकता है तो बहुत easy है, हो सकता है तो करता
बहुत
हूँ
easy है, ये तो कर लूंगी, ये तो मेरे से भी हो जाएगा. And then
मैं.
once you get it, and you'll lose money, you'll make money, I mean, you'll go through that journey, then you'll be like, अच्छा ये मेरे लिए ठीक है, this is not right for me, this doesn't work, you will figure it out. But don't procrastinate and don't try to do this with paper money. I mean, I think one of the things all of us will say is that, investing is a game that is kind of learned on the battleground. It's not learned by sitting and contemplating and thinking. You start with a small amount and go for it.
सही है. Radhika, a few days ago, I was sitting with some of my friends, and we asked this common question to each one of us that if suppose a book is written on you, what should be the title of that book? And
Hmm.
I mentioned, because I believe in this, that I am a
Hmm.
limitless person, and you won't
Oh,
believe it, I did mention limitless for myself. And today I realized someone from your team informed me that you are coming out with a book with the title Limitless, which is such fascinating. So tell me about that book. I love to read books, especially biographies and autobiography. Please tell us about that book.
yeah, so it's not an autobiography. It was a project I took up in the middle of the COVID pandemic. And a lot of people have been writing to me on social media because I write these posts, and I always think they're very simple posts. Why would anyone care? But I think there are, Vivek, a lot of questions that a young person goes through. You go through things like rejection. You ask your questions like, how ambitious should I be? Yesterday, someone asked me a question like, how am I? I'm a really shy person. How do I go out and build the network? And many of these are questions that you can't ask your parents or friends, and you need guidance on them. And I lived through my 20s without that element of guidance. So I thought I would put all of them down, all the limitations, the questions that we have, and share my own stories and also stories of others, who I've known closely, and think about how we can overcome that, develop self confidence, and of course, be a truly limitless version of ourselves. So that's how I did it. I love to write. So I've actually written every line of the book myself, and it's been a 2 year labor of love, and I'm really excited. And I hope it will appeal to, Vivek, we talk about money, and people keep saying, how do I make the highest return on my portfolio, especially a 20-year-old? I think the best asset a 20-year-old has and the highest return you'll get is not from investing. It's from yourself and from your talent. Money is great. And asset, I mean, they say money and asset management is the asset. I think your own talent is the best asset you have, especially when you are young. Uh, and my hope is the book will help people think about how to maximize their talent and to address issues that are deeply Indian, because there are a lot of, issues out there, but there is an Indian perspective, whether it's taking risk, whether it's starting a business, whether it's comparison to the next door neighbor that your parents or you subconsciously have. These are Indian issues. And I thought, let's share Indian experiences and Indian answers, because I really am very optimistic about the potential. I think the Indian youth has one of the lowest PE multiples out there.
Such nicely put. Well, as someone who has been a below average performer in life, an introvert, and always try to challenge himself to become something what I've done, I totally relate myself to the book which you have written. So I'm so keen whenever the release is happening. My wife also loves to read, so she will read and she will make a book review, and we
Lovely.
will spread the book as much as possible because we do get inspired from you.
Thank you so much.
Radhika, it was pleasure talking to you, and thank you so much for this capsules. We talked a lot about life as a whole and mutual fund, and I wish you best of luck for your future endeavors. And just do keep doing what you are doing. We love you.
Thank you so much. It was lovely
Thank you.
talking to you.
Thank you so much. Thank you. What a lady. I'm sure you will acknowledge this. She's amazing. She has such a strong understanding about market, about life, and I'm really, really waiting for that book because I'm sure there is going to be a lot of inspiration from that book itself. If you like this interaction, do forward it to your friends and families, especially youngsters who want to get inspired with her story and also who want to have a great path for themselves in this lovely financial market ecosystem. Thank you so much for watching this video and thank you so much for supporting me in all my endeavors. Bye bye. Take care.